Good morning, everyone, and welcome to the national final round of Ojas XIV FINVISOR, the Investment Banking Challenge, in collaboration with the Finance Committee of SPGMR. FINVISOR is a real-life IPO issue frenzy where the teams proved their financial acumen by planning, strategizing, evaluating, and executing IPO deals as an anchor investor. Simulating the enriching experience akin to that of real-life bankers, we aim to blur the line between illusion and reality while the teams battled it out to close the winning deal. Thank you each and every one of you for being here with us today. Talking about Ojas, crowned as the country's 7th biggest B school fest, Ojas is the flagship management festival of SPGN, Institute of Management and Research, Mumbai, with participation from 100 plus B schools and other colleges across the country. The fest in its previous edition saw massive participation of over 9,000 plus students registering from 25 events from all domains across the 3 days, even when it was virtual. This year, it's about making it bigger and better. From the despair of a disconnected, illusionary world to coming together in the post-pandemic reality, a promise of change and hope marks the 14th edition of Ojas. We are excited to have you all on board with us for the finals, and again, I welcome you all to the grand finale. I want to give my hearty congratulations to all of the teams that are present with us today who have made it after enduring the previous 2 rounds. Now brace yourself and gear up for the final presentations. We wish you all the very best and we look forward to the competition as you give your very best to be crowned as the winner of Ojas 14th FINVISOR. Now I'd like to introduce to you our esteemed judges, Mr. Poojan Shah and our professor, Mr. Hemant Kumar Manoj. Mr. Poojan Shah is a 2014 SPGMR graduate specialized in finance management and has worked with giants like Reliance Capital and Yes Bank. He's currently working as the Associate Vice President in the Investment Banking Division at ENY and is specialized in M&A and PE transaction in the infrastructure and real estate sector. Thank you, sir, for joining us today. Professor Hemant Manoj is the Associate Professor in the Finance area at SPGMR, specializing in finance and investment, derivatives, and risk management. Prior to this, he was working in the industry for over 2 decades in various areas, including fund management and equity research in leading financial institutions across the country. I extend a very warm welcome to both of our judges on behalf of the whole team. Now I will invite Mr. Shah to address the finalists for winning.
Hey, hi everyone. Great to interact with you all, and all the best for the event is all I can say. Do your best. It was a cracking year for hoping all of you are budding investment bankers. Hope in a year's time you will be part of the same frenzy. So this will be a great experience to hear out from you all guys.
Thank you, sir. Now I would request our own professor, Mr. Hemant Manoj, to address the panel.
Yeah, hi, good morning, welcome all of you. I mean, as Piyusha mentioned, you have worked successfully towards reaching the finals, and so congratulations all of you, and do participate in this with vigor and with team spirit, what you call sportsman spirit, you know. So winning is partially your efforts, partially it is a good luck on a good day. So don't worry so much about that. Just be yourself, participate fully, enjoy the process. All the best to each of you.
Thank you, sir. So now I will be debriefing the teams about the rules, the judging criteria, and the flow of the event. Each team will have 12 minutes for the presentation. We will show you an indication on the chart at 10 minutes, and there will be a hard stop after 12 minutes. You are requested to kindly keep your decks handy and present the same while the presentation is going on. Additionally, each presentation will be followed by 8 minutes of Q&A. You are also requested to keep your Excel calculations handy in case the judges request the same. Now, the presentations will be judged on the quality of research, qualitative and quantitative, the valuation model, Q&A, and your overall presentation. I would request if any team has any doubt for the rules. Okay, great. Now we'll start with our very first team. The very first team that's going to present is Fantastic from FMSL.
We can share our screen, right?
Yes, please confirm if you have the sharing rights.
Yes, I do.
Okay.
And the team members of the presenting team at least should have their video screen on, right? Videos on.
Yes, sir. I hope the presentation is visible.
Yes,
Yes.
we can see. Please
let us know when we can begin.
Sure. Can you please raise your hands, whoever is presenting from the team? I request Barambe to please raise your hands.
Yes, just a minute.
Okay, so you can start the presentation now.
Thank you so much. Good morning, respected jury. Today, we team Fantastic from FMS Delhi will be presenting our valuation and investment analysis on Fino Payments Bank. Next slide, please. Currently, based on products offered, the banks can be categorized in universal banks, small finance banks, and payment banks. Payment banks provide banking services like demand deposits, credit or debit cards, payments, and remittance services, as well as ancillary services like cash management services, bill payments, etc. They also act as business correspondent to another bank and offer savings, deposits, credit, and investment products. They also act as corporate agents to offer insurance products and loan products. However, they cannot undertake lending activities and have access only to call money and CBLO market for borrowings. Payment banks have led to proliferation of non-branch type touchpoints. The key advantage of the assisted digital model or phygital model adopted by payments bank are digitization of customer cash and phygitization of local merchants. This unique low-cost model has helped them break through the underserved customer segment from low-income individuals like domestic workers to small merchants like Kirana stores to youth and students in semi-urban areas. Next slide, please. Tinopatek Limited commenced its operations as payments bank from June 2017. After 2 years of developing technological solutions under its current MD and CEO Rishi Gupta, it operates as an asset-light business model that principally relies on fee and commission-based income generated from its merchant network and strategic commercial relationships. The merchant's use of technology and analytics on the data it captures enhances its ability to cross-sell third-party products that it also offers to its existing customers, thereby increasing its potential revenue and opportunity to further customize its products and service offering. The target market of Fino Bank is the emerging India, which is characterized by low levels of financial literacy and technology use, lack of financial inclusion, and is often referred to as the unserved or underserved population. Fino has widened its network through collaboration and partnerships with BPCL to use their outlets as digital banking points. Fino's digital kiosk acts as last mile service point in the under-penetrated regions of the country and has brought about a paradigm shift in the way people used to avail banking services. Fino currently has largest micro ATM network and third largest deposit growth rate with third largest in facilitating digital transactions. As shown in the product timeline, the company has regularly added more services and products to capture opportunities and become a one-stop solution. Next slide, please. We have tried to understand key operating trends to substantiate our assumptions in the model. Micro ATM and APS contribute 33% of total revenue and also act as a customer acquisition funnel for the Fino Payments Bank. It currently holds 55% of the micro ATM market share. The staggering market or merchant onboarding rate of 1,000 per day has resulted in overall transaction value growth of 14 times or 14x between financial year 19 to financial year 21. The market share for remittances or money transfer is 14% and its revenue contribution is at 33%. However, it is also the lowest margin product as it is sourced via API partner. Fino also launched first of its kind subscription-based CASA accounts with simplified fee structure of flat fee model. This is a huge success with over 34 lakh CASA accounts in only 2.5 years, with also year-on-year increase in contribution from renewal revenue. The CASA deposits are expected to grow at a 12% CAGR in semi-urban and urban areas over the next 5 years, and Fino Payments Bank is well suited to take advantage of it. The cash management services include cash collection and payment services across traditional physical channels and help digitize cash to clients. Fino has significantly improved its gross margin as the growth in operating costs were lagging at 20% as compared to revenue growth at 48% CAGR in financial year 19 to 21. It is also venturing into new products like third-party gold loans, insurance products, bill payments, prepaid card payments, etc. Finally, the trends suggest a likely shift towards high-margin products like CASA or CMS, while the diversified revenue stream and strong pipeline of new product launches to give 18% revenue CAGR over next 5 years with overall 300 basis point improvement in gross margin. Now Palash will explain the valuation model with assumption.
Okay, so coming to the valuation part, the core assumptions in our valuation model are terminal growth rate pegged at 5.1% and cost of equity at 13.05%, which has been calculated through covariance and beta method. In addition to that, we have also done a sensitivity analysis on the company's value. The company's value has been turned out to be 515.5, which is 25.68% premium to the date share price on the date on which we evaluated the company. So for the purpose of valuation, we have distributed the revenue into the segments that we previously explained: micro ATM, AEPS, remittance, CASA, CMS, and BC. And we have taken the benchmark growth rates for each of them separately. So we have forecasted the revenue model for 5 years and calculated the PAT and the growth rates accordingly in order to arrive at the value. Let me share a snapshot of the model. I think it's not opening. Okay, so I will just explain the snapshot of the model in brief. So we have taken cost of interest payments as a percentage of expenditure, and we have forecasted it for the coming years. Other than that, we have calculated the employee benefit expenses and all the other things accordingly in the trend that previously was continuing. And we have arrived at the key performance indicators, which will be valuation ratios, profitability ratios, net interest margin, and return ratios for the next 5 years. So valuation ratios, currently the company is trading at 90 to 100x PE and a 6 to 8 book value, which is quite high. But in the coming years, we expect it to dilute as the growth rate currently is around 35%. So it will get diluted to some 20 times at our valuation in 5 years. 13 is the valuation is the PE for current share price, as well as the gross margin and the operating margin have been at 35%. The gross margin is expected to continue at the same rate, but the operating margin is expected to increase as the firm achieves cost synergies in the future. Similarly, net interest margin will be increasing continuously with hitting 4% as the high, which is the standard for HDFC Bank and the top banks of India. and then it will continue to moderate in the future to 3%, 3.5%, and so. Similarly, for the return ratios, the return on assets is expected to be 2 to 7%, as which is quite higher than the traditional banking model, as Fino Payments Bank work on an asset-light model in comparison to other banks. This in terms of risk associated, in the COVID-19, the company was affected and revenue from all the products were impacted, as we have seen in the previous slide also. The negative PE multiple is due to low earnings and negative return on assets and return on equity, as well as fee and commission based activities are major revenue drivers. So the company is highly dependent on the volume transactions, and that is also one of the threat for the company, as competition with higher capital and other payments bank can be threatening to the volume of transactions that the company is conducting. The faster UPI adoption among consumers can also be a point of concern, because that will reduce the volume of transactions in Fino Payments Bank. And as well as we have seen instances of outage in HDFC Bank. So in talking about firms such as Fino Payments Bank, the high reliability of IT can also be a threatening part to the model that Fino Payments operates on. It can break the trust on the bank and reduce the number of customers. It also has limited history of operations, as Payments Bank is relatively new in India, and also it will conduct a high research and development expenditure to expand the products and services, as current operating model cannot grow forever. Also, there are stringent regulatory and prudential norms of Reserve Bank of India, such as CRR, SLR, which apply to Payments Bank as well. And authorization of branches and permissible exposures are also a regulatory roadblock in the development of the company. Also, the company is dependent on merchant network, and the ability of product to deliver products and services is limited. Also, there we have run a SWOT analysis on the bank. Unlike the conventional way of branch-led business sourcing, it has built network via merchant, which is strong, and branch not establishing branch can cause reduction in capex, and ownership of its systems and applications also enable Fino to adapt and create new products. Weaknesses has been one of the most weakness. I have discussed the adoption of UPI and high customer acquisition cost, and opportunities for the bank remains. The overall size of Indian financial services sector is estimated at $500 billion, at which Fino Payments Bank is $31 billion, which is almost 6%, and which is quite high. And highly experienced and committed leadership team, as we have discussed earlier also, and it has deep level of expertise.
Sorry to interrupt, but your presentation type of 12 minutes is up.
Can you just go to the last slide?
Yes, sure.
Can you please visually summarize the same in 10 seconds?
Yes. So we recommend a buy rating with a possible upside of 25% on the intrinsic valuation, while also considering the strategic advantage and risk, as well as the limited history of scale and profitability of Fino Bank. We see at a 35x P ratio, which is on the lower scale of 30x to 50x P range for the similar businesses on FY26 earnings, forecasted earnings.
Thank you so much. Can we have something on the chat or the emoticons for our very own Fantastic from FMS? I would now request our judges to kindly start the Q&A.
Okay, so let me begin then in that case. So if you can go back to your valuation sheet, please.
Yes.
Yeah. So here I'm seeing in your assumptions you have written India is expected to grow at 6.9% and 6.2%. And then you are saying taking optimism, you are still taking 5.1% growth rate.
Okay,
Is it optimistic?
so yes, this growth rate is for perpetuity.
That is true.
So
But that is true. So why are you writing 6.2%? They have 6.9%. If you're writing that, then I'm comparing this number with that. What is your non-optimistic rate for perpetuity?
It will be the standard 3 to 3.5 to 4%.
I don't know what is standard. So it is not written. You should, that I think was more important compared to 6.9 and 6.2. Because if you are saying optimistic compared to what, I would like to know. A. Second part of that same thing, if it is 3%, right, that is the so-called standard growth rate in perpetuity. Is it a real rate of growth or nominal rate of growth? 3%.
It will be the nominal growth rate.
So you are saying India will grow at nominal rate of growth of 3%.
For perpetuity, yes. So we are not, we are assuming the growth rate of developed countries added inflation to that for the standard rate 3 to 4%.
Right. So
is this GDP growth? What is this growth you are referring to?
That this is the nominal GDP growth rate of developed countries presently.
You are saying the nominal GDP growth of developed countries is 3%.
3 to 4%, yes.
And India will be a developed country in 2050.
No, sir. Actually, we do not mean that. But when we talk about terminal growth rate, we are talking it till perpetuity, which includes almost infinite years. So when we look at that, it is usually pegged around 3% to 5%, depending on the company. And for the GDP of India, even though if we continue to grow at 6% to 7% for the next 100 years, but then once we move in the developed stage or in the maturity stage of our...
Fair point. Only thing I would have liked to, just like you have quoted a source and said 6.9, 6.2, I would have liked to see a quoted number of whatever 3% or 4% for developed countries. On what basis you have taken that 5.1?
Sure, sir. We'll improve that next.
I don't know. So, and my second point is, I'm sticking to valuation itself. My second point is, when you're taking cost of equity of 13.05%.
Yes.
So do you think Fino Payments Bank is a more risky or less risky company compared to, let's say, Reliance Industries?
More risky.
More risky. And what do you think is the cost of equity for Reliance Industries, or even, considering that Reliance is a fair representative of the broader market in India itself? What do you think?
That will be the close. That will be very close to the expected market return in India.
Or okay, let me put it differently. What is the method you have used for that?
So, sir, for cost of equity, we have used the CAPM method. So for that, we have calculated the beta using the regression analysis. And with that, we have used
how did you do the regression analysis? When was Fino Payments Bank listed?
Sir, it was listed in November.
So you have 3 months data.
Yes, sir. We only have.
You have done a regression based on 3 months data, and that is how you have calculated the cost of equity.
Yes, sir.
Yes, sir.
The beta was 1.5, so it was fair enough.
No, I'm not talking of the number. I'm talking of the method. So you have used 3 months data and done the regression, and you have accepted that as the result based on 3 months data.
Yes, sir.
Yes, sir, but we have excluded the initial first week because that's when the stock
that is okay. So 2 months, 3 weeks, basically.
Yes, sir.
Yes, sir.
Is there any issue? Do you think this is a good method enough? Good enough?
Sir, we think that it is not accurately reflecting the cost of equity. It might not effectively reflect the cost of equity because usually when we do this regression analysis, we usually take in consideration of at least 2 years of stock movement with comparison to Nifty. But we did not have this data, unfortunately, and that's why we went ahead with this.
So when you are making a projection, is it good enough to say, since we don't have whatever is available is the projection, or is it better to say that we don't have data, we are not sure? The cost of equity could be anywhere between, let's say, 12% to 18%.
Okay, so,
Are you getting the point?
So yes, sir. Sir, we made our point that yes, our data could be a bit inaccurate considering that we are taken 3 months. And
so now you are saying 3 months is good enough. Earlier you were saying that 3 months
No,
is
sir.
not good.
What he
Sir,
means to say is that is why we have also done the sensitivity analysis considering the slight fluctuation in beta, which would reflect in the cost of equity.
So again, your fluctuation of about 0.3% or 0.4%, whatever, on
Yes,
either
sir.
side. Is that a good enough range, given that you are taking only three months data? Okay, fine. So this was in valuation. And my last question, go to the risk slides.
yes, sir.
Or even the previous slide. I mean, there are multiple questions, but yeah, here. So FY23, you are showing your PE multiple coming down from 100 to 41.
Yes, sir.
Even if the price remains same, that means the earnings will grow 2.5 times.
Yes,
right?
sir.
And you have the history of some 2 or 3 years. When was the last time the company's revenues grew 2.5 times?
Sir, it's for 2 years. So,
FY22 and FY23, here I'm seeing the top left chart.
yes, sir. So the current data is for FY21. So from that we are considering.
Yes, sir. So we do understand that from FY22 to FY23, we are projecting that the earnings would definitely be growing 2.5x. That is due to the project pipeline that is currently with the Fino Bank, and they are willing to launch 3 products. One which is a prepaid
No, that
credit.
is all fine. That is all
Yes.
fine. Nisar, my pointed question is, when was the last time earnings grew 2.5 times in the last 3 or 4 years of its existence? And given that, is the earnings growth going to go sharper, higher, or it's going to moderate?
It's
as
going
the
to
company
moderate.
matures?
So initially it would go at a sharper rate and then it will be moderating because there is also a sharp increase in operating margin, as you can see in the second.
So are you saying that beyond infancy stage, first 3 years, startups start growing at faster level in their group in the next stage?
Sir, because they are moving towards providing value to the customers. Initially, they were looking
That is
at
true.
higher
That is true. But you say so. I'm asking you.
Yes.
So
That depends on what sort of
by.
products are being launched by the company.
I understand, sir. I'm asking you again that, okay, past 3 years, it has never grown by more than 100%, but this year you expect it to grow by 2.5 times.
Sir, it is the PAT figure, right? So
PAT.
that is mostly not due to revenue impact, but the cost synergies that the company has achieved.
I'm asking that question only, that PAT has never grown by more than 100% earlier. This year, PAT, you are expecting to grow by 2.5.
What is your PAT estimate for FY22? What is your PAT estimate for FY22?
Okay, so
Palash, can you show the Excel, right?
Yeah, sure. I think it was not opening in presentation.
You can just tell me, that's okay. If it does not open, I'm sure you would have it open on your system. What is your PAT estimate for FY22?
So it's about 343 crores.
Have you looked at the recent numbers that the Fino banks reported? What was their last reported PAT?
It was 200 crores.
That was for which period?
FY21.
Okay. Have you looked at the DRHP which had the H1 numbers?
Yes, sir. We have looked at that. Sir, we have
what was the
estimates from
H1?
that.
What was H1 PAT for that entity? H1 FY22 PAT, which was reported as one of their DRHP finding. What was the PAT recorded in that? Okay, sure, not a problem.
Yeah, I'm not sure.
It's okay. It was only 11 crores. H1 FY22 PAT was 11 crores for this entity.
Okay.
Okay.
Yeah, I think
I just have one fundamental question. So when I looked at the case brief, correct, you were supposed to value this company assuming that the listing had not happened. So just if I want to understand correctly the way you have presented your case, you have valued the company post listing, correct?
Yes, sir. So for cost of equity, we have definitely considered the price movement post listing, but apart from that, the values or the historical data is only till DRHP.
Sure. So when you have taken that into consideration, you did not take into consideration the fact that when this company was listed, there were lots of unknowns, correct? So you had to value a company not knowing how the market will treat it. You had to value a company how the founders or the existing investors would want to value it. So that's fundamentally different from the way the case brief was presented. I just wanted to understand what was your understanding about the case brief.
Yes, sir. We definitely knew that we have to look upon the DRHP for any of the financial statements that we are taking. So for cost of equity, we did not feel that any other method was better. So we just went ahead with this KPM model, and for that we did look at the market valuation of the stock. Otherwise, for all the assumptions or for all the estimates that we have done, we have taken the financial statements from DRHPs.
Perfect. Okay. I think that's it from my end.
Thank you so much for the feedback. We'll definitely
all the best.
Yeah, thank you and all the best.
All the best.
Thank
Good
you so much.
efforts. Good.
Actually, my laptop battery ran out. Sorry for that.
Thank you, sir.
Thank you, Team Fantastic from FMS Clinic. That was indeed a very great start to the round. Now I'll be moving on to our very next team, Gryffindor from XLRI Jamshedpur. Can the participants kindly raise their hands? I request them to kindly share the screen.
Is my screen visible?
Yes, it is visible.
Guys, your time starts now.
Good morning, everyone. We are Team Gryffindor from XLRI, and we have selected Paytm for our evaluation. So Paytm is basically India's leading digital payment platform, and it has more than 5.9 billion transactions annually. Basically, the business is divided into three main segments, which is the payment services, commerce and cloud services, and digital financing activities. So basically, Paytm wanted to raise around 18,300 crores from its IPO, out of which the fresh issue was for 8,300 crores, and an offer for sale from the existing holders was for 10,000 crores. So the reason for raising the funds was they wanted to use it. They wanted to use around 4,300 crores for increasing marketing and promotional spending, and for spending on new technology and merchant acquisition, which is their main business, and 2,000 crores for organic or any new opportunities which may come up for acquisitions through inorganic businesses, and 2,000 crore was for general corporate purposes. So the main advantages of Paytm are that they have a low customer acquisition cost, as well as the two-sided ecosystem, which is they are basically the leading players in both the merchant side of things as well as the customer side of things, which provides them a low customer acquisition cost. Also, some of the key business risks that they face are they are currently contribution positive, but they do not have a positive EBITDA, and as such, due to the increasing competition, it might be difficult for them to generate a positive EBITDA for a very long time. Also, there are certain regulatory risks related to payments bank, as well as there are regulatory issues with data privacy as well, considering the increasing norms of data privacy which are coming up. To give you a brief overview of the entire industry, the Indian digital payment ecosystem is currently one of the fastest growing digital payment ecosystems in the entire world. There are certain factors due to which this has developed. The first factor which led to the growth was demonetization in 2016. Then later on, UPI was launched, as well as FASTags were introduced, and other innovations such as QR codes, as well interoperability of QR codes, as well as uh, uh, all these factors have led to a very fast growth in the digital payment ecosystem. And today, India has currently one of the highest number of digital payment transactions annually. Also, the growth, India has currently around India is expected to have around 1 billion internet users and smartphone users by 2026. So this is expected to increase the mobile payments by around 5x. Paytm being the leading player in the digital payment ecosystem, it is expected to benefit a lot. And as such, it is the only listed player currently. It is the only player where a retail investor can actually invest. Moving forward.
Coming to a brief overview of the company. Launched in 2009 as a mobile-first digital payment platform, Paytm is the leading digital ecosystem in India according to Dcf. Largest in terms of consumers, which is over 333 million, merchants, which is over 21 million, as well as transactions, which is over 7.4 billion. The value proposition that is offered is that of a super app that allows the users to manage multiple aspects in their daily lives, such as Paytm Wallet, Paytm Postpaid, debit and credit card for making payments easier, as well as different financial products such as insurance, lendings, and deposits. Subsequently, the major business components are the super app, which forms the core payment service of the business, Paytm Payments Bank, which allows Paytm to collect the deposits from the consumers, Paytm Money and Paytm Postpaid, which are used for trading and providing monthly credit line respectively. The growth in the economic growth in India, which has raised the consumption and the urbanization, along with the improving pace of digitalization, as well as the regulatory initiatives by RBI and SEBI, are some of the favorable trends for Paytm in India. The growth strategy for Paytm has been to grow the existing consumer and merchant base, expand and improve their product offering, as well as aim to venture into international markets. The risk analysis has been done on the basis of the risk identified in the con calls and the red herring prospectus. The risks have been distributed in the matrix on the basis of their impact as well as the probability of their occurrence. More about the risk in the next slide. Next slide, please. So the risk faced by the company have been divided into the internal, external, and the risks related to the offer. Some of the internal risks that the company faces are that payment has historically been a loss-making company and thus may not be able to achieve profitability going forward. Furthermore, in terms of any changes in the payments that need to be done to financial institutes and card networks, Paytm may not be able to pass on the cost to the consumers and thus may not be able to become profitable. In terms of external risk, some of the main external risks are the high competition, such as Google Pay, Phone Pay, etc., which also exist. The ongoing COVID-19 pandemic may have adverse effects on the operations aspect of the business. Furthermore, the regulatory changes in terms of the payment banks, as well as data privacy and security, may have an adverse effect for the company. Related to the offer, there is no identifiable promoter for the company as per the SEBI regulations. There is no assurance for payment of dividends on the equity shares in the future. And there is the risk of the offer price and the equity share not being indicative of the market price. Coming to the ESG contributions of the company has a vision of making an impact on the economic foundation of the country and aims to make a positive difference by empowerment. For the same, some of the initiatives that has been taken are the use of carbon credit systems for the e-waste, lending out microloans for underprivileged, as well as various donation drives and campaigns in situations of natural disasters. Moving forward.
Yes, thank you. So I'll continue from here. So now let's compare Paytm to some of its competitors in the payment space. So we've identified two major competitors. One is MobiKwik and one is Fino Payments. So as we can see the gross merchandise value trend, that Paytm has about 33% CAGR over 2019 to 2021 in this space. In the same time, MobiKwik has actually decreased its GMV, the gross merchandise value, from 212 crores to about 149 crores. So we can see that Paytm is clearly a leader and they're clearly focusing on increasing the number of merchants and the number of customers through their two-sided ecosystem model. Now coming to some of the major expenses. So one of the major expenses is the marketing expense. And as we can see that Paytm has like its marketing expense as percentage of revenue was 95%. So that's pretty much the entire revenue was used in marketing in 2019. Now they have made some great efforts, and as their founder Vijay Shekhar Sharma rightly said that we have low customer acquisition cost, and as a result now they've decreased the marketing and they're still expecting good customer acquisitions. But nevertheless, the marketing costs are still very high, and out of the 4,300 crores, they are planning to spend some part of it on marketing as well. And due to this, the cash used in operations for Paytm is very high. Like as we can see that it was 125% of the revenue, so they were making EBITDA losses there. And it is still very high at about 65% currently in 2021, as opposed to, let's say, the competitors, which is MobiKwik and Fino Payments, which are at 11% and 4% respectively. So as a result, what we feel is that there have been consistently high losses for Paytm, and Paytm is therefore making losses, and therefore if the model doesn't work and if they are not able to acquire a large amount of customers, then it might cause problems for them. So therefore it is a very risky business model, which is a gold pot if it is successful in the very long. Can you move on to the next slide, please? Yeah, thank you. So now coming to valuation and recommendations. So we've performed two types of valuations, DCF and relative valuation. For DCF valuation, we've taken the gross merchandise value, we projected it, and then we've taken sales as about 1%, and then we've increased it to 1.05% and so on of gross merchandise value. And some of the key line items like EBIT and capex and depreciation, amortization, and so on, we've basically taken them as a percentage of sales, and we forecasted them as well. And the formula used is EBIT into 1 minus T, and then we've added depreciation and amortization, and we've subtracted capex and changes in working capital. For beta, we've taken relative like three companies, their foreign peers, which is MasterCard, Visa, and PayPal, and we've like calculated beta through the relative betas that we've got. And finally, coming to the relative valuation, we've also done a relative valuation of the same, and we've accounted for the changes which were there due to the different financial years of US and India, and we accounted for those changes, and as a result we've come at a valuation of about 921.5 rupees, and we've taken a 50-50% weightage of both DCF valuation and relative valuation. We've also done a sensitivity analysis for Paytm, and as we can see that as G increases to 3.5% and keeping the VAT same, the price is going up to 1,095 rupees, which is like good and so on. We've also considered the fresh equity shares. We've considered that they will be listed at 2150 rupees, and therefore about 4,000 new equity shares will be added, and we've taken that effect and arrived at a net price of 950 rupees. Can you move on to the next slide, please? So these are some of our assumptions to project the key lines, and yeah, that is pretty much it from our side. So thank you so much. Now we are open to questions.
Okay.
Thank you, team. Thank you, team, for the presentation. I would request our judges to kindly start the Q&A.
Just one question. So if you were to justify this number at 2150 of the listing price, what would you need to change in what exactly was wrong in the projections? Because the business has remained the same. It's only the company which has got listed, right? So what exactly would have been different when if you had to justify, let's say if I were to come to you and tell me that justify this price at 2150 for me, how would you do that?
Yeah, what was
In the
going
same
on in Morgan
valuation.
Stanley's mind? What was going on in Morgan Stanley's mind that time?
Yeah.
No
Let's
doubt.
say you are the Morgan Stanley banker. You were part of this IPO, and it's the same math, right? Let's say everything that you have done is correct. How would you justify 2150 if you were asked to justify?
So I think there can be a couple of ways. So first of all, as I said, that the gross merchandise value. So they are planning a lot of customer and merchant acquisitions from both the sides. So
So
they
just
might
one thing, focus on valuation, correct? Don't
Okay.
focus on business, focus on valuation. The question is very specific. You have come up with a price of 950. I want you to justify a price of 2150. What would you change in valuation? I'm assuming you would have prepared a backup Excel
Yes.
where all these numbers are computed, right?
Yes,
So
sir.
from a valuation point of view, how would you justify it?
So I think one of the line items which can definitely change is the take rate, which we've taken at about 1% of the GMV. So the take rate can definitely increase, and Mr. Vijay Shekhar Sharma was even saying the same thing, that currently, other players like Google Pay and other players who are using the UPI, what they are planning is that Paytm will, have so much of wallet presence that as a result, those UPI players will also have to pay the issuer's price and so on. So I think as a
What will
result,
your WAC be? What will your WAC be?
so WAC is about 13.17%. So about
No,
13.
what will it be if it had to be 2000 rupees?
So exactly, we've not seen what will it be.
So
but
you
it
have
has,
the sensitivity analysis table in front of you. Looking at this table, can you tell me the WAC which it should be at 2000 rupee price for Paytm?
it should be around 8 to 9%. Then
Okay. And you told me you have done relative valuation,
yes.
correct?
Yes.
So what exactly is the multiple that you have used for relative valuation?
So sir, we've used the price to sales ratio because we couldn't use the traditional P upon E or the EV upon EBITDA ratios because Paytm's like earnings per share is negative. So I think we took the price upon sales ratio, and we've taken that ratio, a multiple of 17x is taken. Like we've taken a multiple of 17x.
What was the multiple? You said what you took MasterCard and Visa, correct?
A MasterCard, Visa, and PayPal. We took 3 companies.
Okay. What were their multiples?
So their multiples are MasterCard's was 22.3, Visa's was 17.14, and PayPal's was 11.74. So we've
that's
taken an
is Paytm undervalued in that case?
So I won't say
you have given a do not buy recommendation, and the multiples that you have considered tell you that this company is undervalued.
No, sir. So actually, what we've done is we've taken an average of the multiple and we've considered that, okay, this is the right multiple for Paytm. Like rather than going reverse and saying, okay, Paytm's multiple is 17 and let's say MasterCard is 22.3. So Paytm is undervalued as opposed to MasterCard.
Okay. Over to you, Hemant, sir.
Yeah. So let me continue with the same on the same vein. So Pranav, when you have chosen Visa, PayPal, and MasterCard, can you tell me for any of these companies, they are similar to Paytm by more than 50%?
No, sir. I think that is the major problem with Paytm's, like not a problem, but a difficulty you can say as a valuator, because like they are also in the Paytm first games section as well, and they are currently exploring a lot. But our rationale behind taking this was the fact that they are like major fintech companies, and they are also collaborating with banks and so on.
So
and less than, okay.
Yeah, so you appreciate that none of these 3 companies are even 50% similar. Right?
So actually, the main business model is related to payment services for merchants in these 3 cases as well as for Paytm. Like,
So do you know, Harsh, do you know State Bank of India also, a core business is payment services only.
But sir, they do have a lot of regulations to consider as well. They have to move by RBI.
No. I'm saying we have to stick to a line. You said you have taken these because their core business is not core business. One of the key businesses is payments. In some way, they do payments. So I'm saying in some way, State Bank of India also does payments. The key thing I'm asking you, how critically have you evaluated the closeness of these peer group companies to Paytm? Within these three companies themselves, Visa and MasterCard are of one type and PayPal is quite different.
Yes.
And then Paytm is a diversified, I mean, that is what you are presenting as Paytm's description. It has a diversified set of revenue streams. Whereas these companies are limited to payments in some form. Right.
Yes. So first of all, coming to the point of SBI, so I think that it is a bit unfair to let's say compare a startup, a fintech startup to SBI, because like traditional banks, they have very stable balance sheets. So like in that way,
PayPal is not a startup. Visa is not a startup.
I'm talking about Paytm. I'm talking about Paytm, and
I know. So you are comparing Paytm to Visa. So why not to SBI?
So because again they have so first of all, SBI is catering to a very small customer base as opposed to Paytm, which is trying to cater to a very large customer base. And secondly, SBI or any other traditional bank is very stable in this regard. And
that is a different dimension. I'm saying that is a different dimension. When you say the reach is different, do you know what is it that you quantify the reach by? How are you saying that Paytm reaches out to more customers than SBI?
So the target segment is different. SBI might be reaching out to those customers. Like Paytm is basically reaching out to your small merchants who might not be able to go to the bank. Like
anyway,
for a bank, it might not be profitable to. They have a higher cost customer.
My point was, Harsh, I would have, since this is a special company, I would have loved to see some critical analysis of to what extent these peers really matter, because that is the cornerstone of your valuation. You have taken the price to sales of these three companies and used it as a benchmark. So if these three companies are not good enough matching, then the entire thing falls flat. I'm not saying that you have to invent something, but at least mentioning that as a big risk, that was important. Second thing, I never saw anywhere mentioned these three letters, MDR. Have you heard of it?
Yes.
Yes, sir.
I didn't hear from you.
You can take it if you want.
Right? I would have loved to see that as a key risk.
Yes,
sir. Do you think it's a risk or not?
Yes, sir. Yes, sir. I'll take it. So like Paytm earns about 1% MDR from.
No, I don't want explanation. Yeah. How. I'm saying.
Yes, sir, it is a risk because UPI,
If it is a risk, you should have mentioned it. You should have talked about it.
So
that is my simple point.
Yes. So basically, if UPI is majorly adopted, then it would be difficult for Paytm in that regard, because UPI
either you say it's a significant risk, or you say it's not a significant risk.
If
it is a significant risk, then I would have liked to hear from you. That is the simple point.
It is a risk. Yes.
Yeah.
We agree.
Okay. I think our time is also up, so we'll stop here. So thank you, sir.
Thank you, sir. Thank you for your insights, and we'll try to inculcate them in future valuation.
Thank you, Team Gryffindor from Right. Please show some reactions in chat. Now we'll be moving on to our next team, which is Bank on It from NMIMS Mumbai. I request the participant to kindly raise their hands. I request Harsh from Gryffindor to kindly go ahead. Thank you. Kindly share your screen so as to ensure that you're doing.
Sure. Please let me know when you can start seeing my screen.
Yeah.
We can see your screen now, Yogesh.
Sure. I think.
Okay, team. So your time starts now.
After a series of successful rounds of fundraisers, PB Fintech opened its IPO in November 2021 with the objective of using the funds for increasing their brand visibility, undertaking expansion plans through organic means by offline expansion of centers, and with a vision for inorganic expansions in the future. Good morning, judges. We are Team Bank on It, and today we would be presenting our analysis for PB Fintech, where we have arrived at a target price of 1,062 rupees with a 11% upside and a subscribe rating. Moving on to the next slide. The implementation and adoption of fintech has grown exponentially in the last few years, and it is projected to have an even larger growth in the future. India's fintech market is one of the fastest growing in the world, with India having the highest global fintech adoption rate of 87% compared to the global average of 64%. The Indian fintech industry is currently valued at $31 billion, and it is projected to grow to $84 billion by 2025 at a CAGR of 22%. This growth has been aided by the country's favorable demographics and the increasing number of people in the working age group, which is driving greater consumption and faster adoption of digital trends. The increased availability of smartphones at affordable prices and internet penetration is also driving growth in fintech services. Apart from that, government initiatives and infrastructural support and COVID-19 has proven to act as catalysts for this growth. Moving on, the fintech industry can be roughly divided into 4 segments, that is the payments, lending, insurtech, and the wealth tech segment. Over here, we would be focusing on 2 main sectors, which our company operates in, that is the insurtech and the lending segment. So the insurtech segment is expected to grow at a CAGR of 19% by 2030, which is driven by the rapid pace of digitization, customization of products, and digital distribution channels. The low penetration of the insurance market also shows the significant scope for growth in this sector. Whereas the lending segment too is expected to grow on the back of the massive opportunity that is present in the MSME and the consumer space, with the focus areas being consumer and business loans. Now moving on to the company overview. Over to you, Varnika.
PB Fintech, incorporated in India in 2008, has built India's largest online marketplace for insurance, Policy Bazaar, and lending products, Paisa Bazaar. Policy Bazaar was launched in 2008 and makes up 68% of PB Fintech's revenue. It is the flagship online platform for consumers and insurer partners to buy and sell core insurance products. With a market share of 93.4%, it is India's largest digital insurance marketplace. Until June 2021, Policy Bazaar was registered with IRDAI as an insurance web aggregator. But in June 2021, it received broker license from RDAI, which allows Policy Bazaar to now target offline and corporate businesses in addition to online business. It also makes it eligible for renewal commissions in the life insurance business. Paisa Bazaar was launched in 2014 and is an independent digital lending platform that enables consumers to compare, choose, and apply for personal credit products. It is also widely used to access credit scores. With a market share of 51.4%, it is the largest digital consumer credit marketplace in India on the basis of disbursements. With a tie-up with over 54 BFSIs, Paisa Bazaar seeks to resolve fundamental issues that consumers face when accessing personal credit products. With an asset-light model and a wide range of options available for its consumers, PB Fintech also gives its customers and partners the benefits of its proprietary technology and segmentation, which provides customers with targeted solutions to their needs and convenience while comparing or purchasing products online. Now, moving on to the next slide.
Now, moving on to financial analysis. The things which we really like about the company is the predictability towards profitability, which is not definite in the other new age listings which have come to IPO. The company is expected to have a strong show over the next 5 years, delivering a revenue growth of 26% over FY22 to 26. We expect the revenues for the company to reach 50 billion in FY26 from a current 800 million in FY21. The company currently has a negative net profit. We expect the company to be profitable FY25 onwards and reach a net profit margin of 6% over FY26. The company has also spent a lot on advertisements with almost 40% of the total expenditure allocated to marketing activities. The company is expected to gain scale in terms of marketing and reduction in sales to advertisement ratio. In our model, we have assumed the marketing cost to dip from 40% in FY22 to 36% in FY26. With explosive growth in sales and maturing margin profile, we expect the return metrics of the company to improve significantly going forward. According to our model, the company will break even on EBIT level in FY24, and then by FY26, the ROCE will jump to 19%. Now, moving on to financial statement assumptions. For revenue forecasting, we have assumed the market share of Policybazaar to increase from 0.5% in FY21 to 2% in FY30 in the total insurance premium issued. The company collects commission on premium distributed. We have assumed the company will continue to get 13% of the total distributed premiums. For Paisabazaar, we have assumed a CAGR of 20% in terms of loan disposals, which is 1.5 times the industry growth rate. Take rate for loan disposals is assumed to be 3%, which is industry standard. Overall, we believe the company is going to deliver solid numbers over the long term. The company wants to shift to an online plus offline model, wherein they'll need to spend more. We believe with additional funds post-IPO, CapEx will stay at an elevated level and will moderate in the long term. Lastly, we believe the company on the strong tailwinds and huge untapped market, PB FinTech, is set to grow in line with the long-term GDP growth rate. So we have taken a terminal growth rate to be 6%. We have used DCF to value PB FinTech, and we have arrived at a fair value of 1,062 rupees, which implies an upside of 11% from the IPO price. To arrive at a weighted average cost of capital, we have used CAPM method. And as the company is not listed, we have used the bottom-up beta approach, using its closest peer to arrive at a weighted average cost of capital of 9.05%. Our subscribe rating is in line with the street rating, where out of a universe of 7 brokers, 5 brokers have a subscribe rating. Now, I'll ask Vanita to take over.
Moving on to the investment rationale. The insurance industry is highly underpenetrated in India, where the sum assured as a percentage of GDP is a mere 25% as compared to 95% in China and 265% in US, while the share of online channel is just 1%. However, with the insurance industry expected to grow at a CAGR of about 19% by 2030, accompanied by increasing customer preference for online over offline channels, Policybazaar has a very good future outlook for itself. Similarly, the consumer lending market in India is also underpenetrated, where the outstanding consumer debt as a percentage of GDP stood at 17% for India and 56 and 79% for China and US respectively. Again, the disbursements through digital marketplaces were only 1% of the total consumer lending disbursements. With consumer lending disbursements to grow at 20% CAGR by FY36, there exists a meaningful opportunity for Paisabazaar's current digital lending offering to tap in collaboration with its lending partners. Both Policybazaar and Paisabazaar are leaders in their markets and have strong brand recall and are collaborative partners for the insurer and lending markets. It provides its partners with access to large user bases of both Policybazaar and Paisabazaar and helps them use data insights for targeting customers, which helps them increase efficiency and reduce the cost for customer acquisition. Apart from this, a major lever for Policybazaar's growth would be its receiving broker license from IRDAI, which would increase its share of renewal premiums in overall premiums, which would boost its contribution and EBITDA margins, given their near zero marginal cost for the renewal business. Hence, we are bullish on the company. Now, moving on to the next slide.
PB FinTech exists in a highly emerging market where it faces severe competition from its peers, both in the insurtech segment as well as in the lending segment. However, due to its strong brand recall and products offered, it still enjoys leadership position in the market, where Policybazaar has a 93.4% market share on the basis of policies sold, and Paisabazaar has a 51.4% market share on the basis of loan disbursals. Here we have compared a few operating metrics of the company with some of its closest peers in the market to gauge the reason for its dominant market share. So both Paisabazaar and Policybazaar continue to earn a revenue that is much higher than their peers. and the number of tie-ups or partnerships that the company has is also significantly high. So Policy Bazaar had around 51 tie-ups in FY21, while Paisa Bazaar had 54 tie-ups. And also owing to its strong brand recall, it enjoys the highest number of site visits compared to its peers. This again emphasizes the reason for PB Fintech's leadership in the market. Moving on to the next slide. So even though the company maintains significant leadership in its product segments, PB Fintech faces several internal and external kinds of risks. So we have plotted the same on the risk matrix on this graph on the basis of its probability of occurrence and the impact of risk. One of the major risks that it faces is competition from new or existing players or from partners aggressively building and promoting their own platforms or leaving the platform for any reason. So currently, revenue from life insurance distribution business is mainly contributed by 5 major insurers, which is approximately 93% of the revenue generated from life insurance distribution. So therefore, high dependence on partners also poses a huge risk. Apart from that, any macroeconomic risk in the form of COVID flare-up or change in fees or commissions agreed to by the partners could also affect the business. Any disruption to technology of the company or changes in law and regulations could also pose risk. Apart from that, the company has also been focusing on the ESG front with various environmental and social practices like providing relief helplines and organizing blood donation camps for COVID patients. It also provides various employee welfare schemes. So that was our analysis of the risk in ESG that the company is doing. And that was all from Team Bank on it. Thank you, judges. We are now open to questions.
Thank you, team. I will now request our judges to start.
So let me ask you on this slide itself, between competitive risk and partnership risk, you have done a good thing of presenting the risk matrix. What, by the way, it has a name. Do you know this matrix? What is it called?
So the risk matrix. So I'm not sure of what it is called.
It's a heat map. It's
heat map. Sorry. Yeah.
Okay. So here you are putting competitive risk above partnership as a risk, right? If that is the view, then in the previous slides, when you are showing the percentage visits and conversions and things like that, why are you mentioning that has predominantly ahead of the competitors? It is getting the maximum share of revenues, kind of well established. I'm not seeing which one is a bigger risk.
So I completely agree with your point, sir. So according to what we thought, we felt that a competitive risk could pose as a huge threat to the company because of the new players and smaller players that are entering the industry, and any disruption in that space could affect the company in a major way. Also, dependence on partners is also a very big risk, but I think the company mitigates this risk because it has a very transparent platform where insurers would want their products to be visible because it provides visibility, and also consumers are preferring online mode and they want to compare different products of different insurers. So that is why we kept dependence on partners a little lower compared to competitive risk. But if anyone from my team would like to add on.
So I think competitive risk is much higher than the dependence on partners on the basis of, so a lot of new companies that are coming in the fintech space, their motive is not initially, their motive is not to make profit. They just want to flash money and they just want to gain market share. So the competitive risk stands much higher than the partners risk, because partners, they want to be visible on their platform, because Policy Bazaar being the largest insurance aggregator, if they are not there on Policy Bazaar's platform, then it would be a huge setback to the partners itself.
I'll just
okay. And then yeah. So frankly, I would have preferred this is good. fairly good answer, but I would have preferred a sharper answer on why do you think competitive, because they are very related. Competition, one part of it is getting the partners on your platform continuously.
So one point that I would like to add is that while the impact of both the risks would be the same, they would be as high, but the probability of occurrence of the partners leaving the platform is lower because of the customer traffic and visibility that Policy Bazaar generates for its partners. And as we know that the life insurance business, it's a very sensitive, like brand sensitive business, and key market players like 5% or 5 major players occupy the major share over there, and approximately 65% of the total policy sold online was by Policy Bazaar. So because of that, no brand can afford to move out from Policy Bazaar platform. So that is
So
why
it's okay. It's okay. As I said, yeah, broadly, I don't disagree with you, but I would have liked a sharper answer, because sometimes it's a good answer that we don't have the answer and it's our gut feeling.
Yeah.
That's also a fair answer, right? Okay. And then another thing, finally, you devoted less than 10% of your time on valuations. So is it that you don't want to talk much about it, or is it that you are very confident so you don't have to spend much time on valuations?
So it was just that we wanted to cover as much as we could in the 12 minutes that were given. So
that is why, so 90% you covered on others and only 10% on valuations.
So we have been focusing on the fundamentals of the company. That has also been reflected in our valuation analysis.
What is the method? If you could go to that slide, what is the method you adopted for valuations?
So you adopted a DCF method for our valuation.
Right. And here the WACC you have taken is base case is 9.05%.
Yes, sir.
And currently it's all equity funded, right?
Yes, sir. So the proportion of it is really less.
Yeah, almost.
Not significant.
And you think, just step back from the figures, you think 9% as the cost of equity is a fair, because we don't have time here to go and get into details, but you think that 9% is a fair rate for a high risk company which is not even making profits currently?
Sir, I believe PB FinTech has a definite part to profitability. So what we have done to arrive at the valuations is we have taken the bottom-up beta approach. So what we have done is we have compared the beta with we have taken the asset beta. So we have taken the peers as the platform businesses which exist in the market, which is scams, which is CDSL and ICICI securities. So we have done the bottom-up approach of the beta, and we believe a weighted average cost of capital of 9.05% is justified because the.
So what is the data length you have taken?
So we're taking 5-year average for the companies which are listed.
How is it 5 years? It's not listed for 5 years. What did you
do?
do?
So we have done we have taken the beta for the for CAMS, ICICI securities, and CDSL, and then what we have done is we have unlevered it, and then we have levered it.
Oh, you have taken the betas for them.
Yes. So we have done the bottom.
CAMS.
Yes, so for the companies which the data was available for 5 years, the maximum data which was available.
And that is how you have arrived at the beta of 0.59.
Yes.
That is a fundamental error actually here. That is why you are coming to 9.05%. You are having a company like Policy Bazaar at 0 or whatever, this company at 0.59 beta. The implication of that, I'm sure you understand.
So we believe the company is comparable to them because all of the companies that we have compared it to, all of those are.
Yogesh, the food is only as good as it tastes finally. Whatever you have done in the kitchen, that is, the consumer is not interested. I mean, consumer, if she has time, they would be happy to go and investigate how well you cook. But if it doesn't taste well, there's certainly something that has gone wrong.
Yes.
Right. Okay, but good efforts. Sorry, Pujan, you.
No, so if you go to your DCF projections once, okay. So it's a linked question, correct? So you, you have So this particular business, as per your projections, it requires these numbers are in what, INR lakhs, correct? So you are projecting a negative FCFF for almost next 3 years, correct? So, and then you are assuming a cost of equity of 9%. So then are you saying that since there is no debt, all of this money will be invested, and the founders or whoever are the investors, they expect a 9% return on the money that they're investing?
Yes, sir. The weighted average cost of capital is 9.05%. So,
okay, so in your mind, this if let's say today this particular company were to be sold 100%, let's say you find a new buyer out there somewhere who's interested in just buying lock, stock and barrel, so that means they would be okay to acquire a high growth company with equity returns of 9%. Do you invest in mutual funds?
yes, I do.
What is your expected returns from a normal SIP that you would do?
So, sir, our commentary about PB FinTech is so now the IPO price is 960 rupees, and we expect an immediate price appreciation of 11% for PB FinTech, which is the listing gains, and then post that
What did it close yesterday at? What did it close yesterday at?
It closed at 780 rupees.
Okay. Did the founders sell their shares yesterday?
Yes.
I'm not. Yes.
Okay.
The founder.
So now my question is very fundamental. You have projected. So I think there is some amount of reality in the projections that you have done, correct? Then that it won't be turning profitable very soon. My question is linked to the expected returns that you would want, because this is an equity business at the end of the day, correct? There is no leverage over here. So in your view, getting a 9% return on a high growth company is a fairly good expectation. Is that a fair conclusion to make basis the numbers that you have projected?
So, sir, in our case, what we expect is 11% upside immediately, and then post that we'll get 9% every year. So this is what our expectations currently is, and which I feel is very justified given that given the current scenarios in the market.
Sure. So if we make you the investment banker, you will be able to sell it at a 9% proposed return.
Yes.
Or let me flip it. If you are the fund manager investing 1,000 crores in this company, you would be okay with a 9% return.
Yes, sir, I would be, because what we believe is the company is a platform, will become a very mature business going forward, and for a platform business which has a definite road to profitability, I believe a return of 9% post the 11% subscription gain, I feel that is justified.
Okay, sure.
Okay.
No further questions from my side.
Yeah, thank you.
Thank you, team.
All the best.
Thank you, team.
So much, sir.
Good effort.
Thank you, Judge, for your feedback.
Thank you, judges, for the feedback. We would take that into consideration.
Thank you, Bank on it, for that presentation. Now we will be breaking for 10 minutes, and we will continue with the next team, which will be frontliners from IIFT Delhi.
So 5 minutes, right? Yeah.
So 10 minutes.
10 minutes. Okay. I'll be back. Thank you.
So we have 2 more teams, correct? You sure?
Yes, sir. We have 2 more teams. We'll be back at 10:30.
Yeah. 10 minutes will be back. So 11:40.
11:40. Sorry, sir.
11:40 we can start. Okay.
Yeah, 11:40 will be back.
Sure. Thanks.
Fair. Good.
Welcome back, everyone.
Yeah, Piyusha, I'm back.
Hey, hi.
Okay, so I request the next team frontliners from IFT, can you raise their hands? Can you share your presentation?
Yeah, I'm sharing the screen. Is my screen visible?
Oh, Anmol, it's black. Yeah, it's visible.
Okay, guys, say your time starts now.
Thank you. Good morning, everyone. We are Team Frontliners and here to present about PB Fintech IPO. Now moving to investment thesis, PB Fintech provides convenient, and we'll move to next slide. PB Fintech provides convenient access to insurance, credit, and other financial products and aim to create customer awareness about Indian household, the financial impact of debt, disease, and damage. Through their customer-centric approach, they seek to enable online research-based purchase of insurance and lending product and increase transparency. PB has decided to go for IPO with the objective to enhance visibility and awareness of their brand, new opportunities to expand their customer base, including their offline presence and strategic investment and acquisitions. They also want to expand their presence outside India. Now, details of IPO we can see here is that they are offering with a price band of rupees 940 to 980 and with a minimum lot of the size of 15. Fresh issue will be around 65.6%. In whole issue, qualified institutions will have a market size of 75%, and the rest is divided between non-institutional bidder and retail. Now, why we should invest in PB Fintech? So there's a lot of room for insurance penetration in India, and the online market is still penetrating rural parts of India. Policybazaar has major market share in online industry despite of several bigger insurers. Policybazaar is going omni-channel and has decided to foray into physical business too. It has improved margin and profitability via operating leverage, a greater renewal base and technological investment. Paisabazaar, which is started in 2014, is a synergistic company that can cater to a larger credit market. Now coming to the industry overview, moving to the next slide. Driven by increasing disposable income in India and a discretionary need for insurance size during COVID, we expect life insurance to grow at a 14.3% CAGR during fiscal year 21 to 31 to reach 24 trillion in total premium by fiscal year 31. According for the 72% of the overall insurance market. However, life insurance continue to be tougher to sell digitally due to their complicated terms and conditions required. Hence, we expect digital share in life insurance to reach only 2.4% by fiscal year 31. The other insurance market will also grow at a CAGR of 14 to 15%. Now, Indian consumer lending market has grown strongly until COVID crisis, with disbursal reaching 13.5 trillion in fiscal year 20. However, fiscal 21 has seen a small blip with COVID-related uncertainties impact both demand and supply for the consumer credit. We are now starting a decent reversal and projected that this market will reach 65 trillion by fiscal year 31 with a CAGR rate of 7.5%. Major growth in the industry are financial literacy, technological advancement, digitalization, and rising per capita income. Now moving to the next slide, PB has two major segments. Policybazaar was India's largest digital insurance marketplace with a 93.4% marketplace based on the number of policies sold. And it has transacted 65.3% of all digital insurance sale in India by volume. Paisabazaar, which was only started in 2015, but is still India's largest digital consumer credit marketplace with a 53.7% market share based on dispersal, premium from renewal Premium from renewal is also around 40%. Paisabazaar has partnered with 56 large bank NFCs and fintech leaders. It has provided credit across personal credit categories, including personal loans, business loans, credit loans, etc. Paisabazaar has done really well in providing free credit score. Currently, 22.5 million active users access using these credit score. 67% of the loan dispersal is from the people who are using these credit score, and rest are from the existing user. Paisabazaar contribution to the revenue has decreased in recent time. As we can see, in 2019, it contributes to 28%. Now it has changed to 16% in Q1 fiscal year 2022, but it is supposed to grow steadily in the coming years. Over to you, Anmol.
Thank you, Vedika. So for valuing the company, we have used a discounted cash flow method. To account for the valuation of fintech industry, we have used peer comparison and incorporated into revenue growth. DCF is done for next 10 years, starting from FY22. Valuation is done in two phases. In phase 1, the revenue is increasing as PB will acquire more customer base and expansion into sister businesses, driving revenues up from 12% to 41%. Phase 1 will last for 5 years, and for next 5 years, revenue will subside from 41% to 10% growth. Breaking down the revenue projection into business divisions of PB Fintech, PFL demonstrated a robust revenue growth of CAGR of 34.2% to INR 887 crores, driven by Policybazaar insurance platform growing at a CAGR of 25.1% to INR 609 crores. Paisabazaar, the lending platform revenues growing at a CAGR of 6.8% to INR 188.3 crores. PB Fintech, which is marketing, consulting, and other revenues growing at a CAGR of 49.6% to INR 91.4 crores. In future growth phase, the consolidated revenue is expected to grow at a CAGR of 41.6%, 37.5% CAGR in Policybazaar, 36.6% CAGR in Paisabazaar, and 71.6% CAGR in growth rate of sales and depreciation at the end of with the growth of company. WACC is broken down into components and projected using market data and comes out to be 13.82%. It's from RBI website, and data is calculated using the based approach, and it from using the market data as well as and comparing to Nifty 50. So when we perform the DCF, the equity value per share comes out to be 1,030 INR, which is around 19% upside from its current market price of 868. Thus, show the potential of PB Fintech in coming future. And thus, its IPO was well received by the market, listing at 17% premium at 980. The three key estimators we used for this valuation are CAPEX, DNA, and revenue. Over the long run, the company will make positive investment and impacts will grow with revenues at 3% of revenue starting from FY27. DNA will grow as CAPEX grows, and eventually depreciation and amortization will be at 94% of CAPEX as company's past investments will be accounted for. The company is expected to make positive operating profit from FY25 and EBITDA till FY29-30, showing the maturity phase. And at this point, the company should look into measures to reduce the cost by organic or inorganic methods.
Coming to the risk factors, next slide. So the company's established procedures and operating norms are outpaced by the velocity of work, fluctuating market conditions, and the rate of unanticipated changes, which might result in operational risk. In addition, PB may experience difficulties as a result of insufficient premiums received for risk underwriting. There is also the possibility of policyholder claims not being paid and investment instruments going into default. The insurance industry is highly competitive, which makes it difficult to enhance consumer engagement in a cost-efficient manner. PB needs to comply to certain regulations, and their inability to comply with these may adversely affect the business, results of operations, and reputation. Moving to the ESG analysis. The company has been awarded multiple times in the recent years for their initiatives. Beginning, Anmol, next slide.
I've seen the slide.
Yeah, okay. Beginning with environmental approach, PB has established a health, safety, and environmental framework with the goal of assuring workplace safety, warehouse and logistical operation safety, road safety, and effective scrap or waste disposal. Under social initiatives, PB has supported Government of India in handling the pandemic. An employee assistance program was also initiated to take care of the well-being of employees. PB is also a core member of the not-for-profit SOST Alliance. Under the government initiatives, the board composition would include 10 directors with a fair share to women directors. company has also created various committees to promote global sustainability and CSR management. With this, we come to an end to our presentation. Thank you for your time, and we are open to questions.
Thank you, Team Frontliners, for that presentation. Now I would request the judges to kindly start the Q&A.
If you could continue to share the presentation, please, that will be helpful. I was excited, actually happy when last slide, when you said that they are giving good representation to women directors compared to others, right? Which is I was happy about that. But your next sentence, or rather the graph, actually put me off. If you could share this presentation, please. Yeah. Do you know regulatorily what is the minimum number of, or is there any threshold for women directors in listed companies? You may not be aware. You are not.
Yes,
sure.
so it's the limit is around 2. Like minimum 2 should be there on the board.
No, it depends on the board size. If there are 20 people out of that, 2 doesn't make sense. 30%. Last slide, in your last slide, right? When you say there are 30% women directors, they are just meeting the regulations. They are not doing anything special. I would have been happy if you had espoused their case by saying that they are going to have 50% women directors, right? So this was a finer point. Okay, now coming to your good. You can read my mind. That same slide, valuations.
Sir, is my screen visible on full screen?
Yeah, but this one, just stay there. Just stay there. Don't do anything. Sure. Right. The growth rate is something. So we will not ask you about discount rate because we have talked about it with the previous group, and partly I agree more with your discount rate of 12.59%. But so let's look at the growth rates. I mean, you are seeing FY22 expected, EBITDA is minus 6,000. And then by FY24, within 2 years, they are expecting they will almost become zero EBITDA. And then FY25 onwards, they will start making huge profits, right? That line between revenue and EBITDA, the space between revenue and EBITDA, that makes a lot of difference, right? So what exactly gives you the confidence that this is going to happen?
Yes, sir. So for this, when we look at the fintech industry outlook and the digital insurance space, which has been heavily dominated by Policy Bazaar, and the way they are expanding into credit, we believe that in coming years, they will be able to gain strong foothold, and this operating margins will increase for them as they expand into other businesses and other geographies.
Sorry, Anmol.
Yeah.
There are 2 ways, if you can answer me. One way is saying that these are the 3 big expense items for them. These are the 3 big operating expense items for them. And within these, this one will fall sharply. Or you can say we have just taken an increasing EBITDA margin, and this is where it is.
One second. Sir, I just want to add a point here. That's EBITDA will decrease in initial year as the company is falling into physical space. So for physical, they have to expand. So basically, there will be an expense for like physical expansion. So because of that, EBITDA will decrease.
In fact, it should fall if that is the case. EBITDA margin expansion is cheaper if you expand digitally compared to expanding physically.
I say that's why EBITDA is falling.
You will have to hire more people visiting, salaries, expense, operating expenses of the branches. So I'm saying, have you just gone by broad gut feeling? EBITDA margin will increase from X% to Y%? Or have you done a calculation line by line?
So for this EBITDA margin, we have referred to various research reports wherein they say what will happen.
Right. So you have come straight to the EBITDA margin by looking at various sources.
Yes,
That
sir.
is what I have been asking, because this is too optimistic. Okay. So I think I will pass on to Pujan.
So I was curious to look at your capex line. So okay, are these numbers in what, million?
Yes, sir. These are in INR million.
So can you just explain what exactly is happening? So you have almost 60-70 crore capex up to 25. What happens to capex after that? Why does it turn positive?
Yes, sir. So for that, we believe that when we look at the company's past 3 years data, we see that the company has been making negative capex, means they are taking money out of it. So we believe that in coming years, the companies will invest in more businesses to grow organically, and therefore after when you see FY 24-25, we believe that the company should be investing more, and then that's why we are assuming that company will in the growth phase and the maturity, at the end of growth phase and start of maturity phase, company will be investing approximately 3% of 3% of its revenue each year, so that the growth should be in line with whatever the revenues they are increasing in when you see in the revenue chart.
Sorry, I have a very basic math question. So when your capex is negative, does that mean so let's take FY24. So are you saying 70.6 crores is taken out of the business, or 70.6 crores is invested into the business? What does negative 706 mean?
So for this negative, we are trying to say that company has been taking out of the money in capex. They are getting cash flows from investment activities. But for a company to grow, they should be investing more in their business.
Okay, just hold that. So then you are saying in that case, this is 3% of sales. So from 26 to 31, the way your numbers are working currently, these are the actual investments that they will need to make?
So we have assumed that they should be making a percentage of their revenue back into their business. So we have assumed 3%. That should be the case in the long run.
Okay. So if I were to ask you a very simple question, you understand what EBITDA stands for, correct? That's the free cash that and this company does not have debt. So in 26, your business has generated 1600 crores of EBITDA. Correct? So are you saying out of the 1600, 196 crores should be invested back in the business? Is that the money available for investing in the business? What is the money available for investing in business?
So we think that should be a percentage of sales, not the percentage of EBITDA that should be invested back into the business. I think that from EBIT, the investment will not only come from EBITDA, but from other sources of investments as well, like debt, and which company like debt, which company does not have any debt right now.
Have you assumed debt?
So we have assumed the 3% of sales. We have not yet not decided on the sources of capex that should be accounted for.
Okay, so your equity value, which you arrived at 160,684, correct?
Yes, sir. Yes, sir.
What will happen to this equity value if this capex is funded by debt?
So equity value will reduce in coming years. Yeah.
Okay, and so right now it's all equity funded. That's what you have assumed. Is that the way your model is working?
Yes, sir.
Okay, and so when you have assumed the revenue growth for these all the initial years, so the CAGRs that you mentioned on the earlier slide, so that's a CAGR over how many periods? So you had, if you go to your previous slide, there was a reference somewhere on CAGR that you have assumed for each business line, correct? So
yes, sir.
When I look at this number, 37.5% CAGR in Policy Bazaar, correct?
Yes,
this is over a period of how many years?
So for whole DC in growth periods, for the period of FY22 to FY26.
Okay, sure. Thanks. I think that's it from my side.
Thank you, sir.
So, sorry, I mean, the follow-up question, what has been the past 5 years or 4 years CAGR?
So for past 4 to 5 years, for 19 to 21, the CAGR has been 34. Can you come on to the previous slide?
34.2%
in FY 19 to 21.
And you are expecting that CAGR to go up actually.
Yes, so for in the growth phase, we're expecting to grow up and then eventually subside.
That's a strong assumption. Okay. And final comment.
Sorry. So just one question. In your view, what is the single most important element which will impact your valuation model from the current estimates that you have to make this a really a very bad investment? Like, what is the single most critical element which is important for success of this company?
Yeah, so for our model to work, I believe that the revenues growth should be in line with whatever we are projecting. If it is not, that model will not be accurate.
Okay, sure. Thanks.
Thank you, sir.
Yeah, I think
Thank you,
we are done.
Thank you, sir. Thank you, Franz Reiners, for the amazing presentation. Sir, due to one team falling out, the last team, which is not too far from NMIMS, is currently having an exam and I've requested to join at 12:20. Would that be possible or should we continue without them?
No, so we are saying that the next one team will come at 12:20. So in that case, we will take a break for 20 minutes and come back again.
So we could do that as well, or if any
Oh,
of
there
the
is
teams
another
would
team
like,
left. Okay.
the last team is left. That is the India
We
team,
can
which
do
will
that.
join at
Yeah,
12:20.
that is okay. Sequence here.
Sure, sir. Till then, if any of the teams want some feedback from the judges, would that be all right?
Just one thing, which was the team that just frontliners was the team that just presented, correct?
Yes,
Okay,
sir.
sure.
So if that is all right with the judges, we will take a break for 15 to 20 minutes till the last team joins back.
Yeah, should be fine. That's okay. I'm okay. Are you okay?
Yeah, I'm fine.
Thank you, sir.
Then 12:50.
So what is it's a 20-minute break? Is that
Yes,
what
sir.
you're saying?
Yes, sir. They'll join back at 12:20.
12:20.
Okay, sure, not a problem.
Okay.
Thank you, sir.
Thank you.
Good afternoon, judges. All present here.
Good afternoon, judges.
Hey, hi.
Welcome back. Are judges back?
Yes,
Okay,
Piyusha,
guys.
we are back.
Okay, guys. Can the next team, not too far, please raise their hands? Kindly present your screen.
Just give me a minute. Is a white screen visible?
Yes. Okay, guys. So your 12 minutes.
Yeah.
Team, let us know when can we start.
You guys can start.
Thank you. Good afternoon, everyone. Today, team not too far will be presenting our anchoring valuation report on Vijay Diagnostics pre-IPO. Diagnostic services currently have an 8 to 14% share in the overall healthcare spending and is expected to grow at a CAGR of 14% over the next 4 years. 74% of diagnostic centers are urban and 57% of tests are pathological in nature, while the remaining are radiology tests. The Indian diagnostics industry is highly fragmented given the high proportion of standalone centers and hospital-based centers, which collectively comprise 85%, whereas the diagnostic chains comprise only 15%, further split into regional and multi-regional chains, of which regional chains account for the majority. However, the industry has witnessed a shift from standalone centers to diagnostic chains due to increasing trend of patients' reliance on diagnostic chains for their quality of services and unavailability of complex tests with standalone centers. Talking about drivers, with the Indian population expected to grow to 1.4 billion by 2026 and the rise of senior citizens from 8% in 2011 to 13%, the need to ensure that the healthcare services provided to this vast populace is imperative. The contribution of non-communicable diseases to the disease profile has risen from 30% in 1990 to 55% in 2016. In terms of pricing, Dr. Lal Path Labs and Vijay Diagnostics fall in the premium pricing range, while Thyrocare and Suraksha Diagnostics fall in the low price range. However, in cases like lipid, the Thyrocare charges much higher than Dr. Lal Path. In terms of pricing, in terms of operations, Vijay Diagnostics has the highest EBITDA percentage margin in its competitors, with one of the highest revenue growing diagnostic centers in Southern India. The pattern is mirrored by the profitability, with one of the highest EBITDA by patient and EBITDA by test ratios. The high profitability comes from the fact that 93% of its revenue comes from the B2C business, which is based on high margins. Now, diving more into the company specifics, Vijay Diagnostics is the largest integrated diagnostics chain in Southern India by operating revenue and has an extensive network of 81 diagnostic centers and 11 labs. Over 80% of the company's revenue comes from the centers in Hyderabad, and over 95% of its geographic expansion is restricted to Telangana and Andhra Pradesh. Vijay's value is a combination of three factors. First, a hub and spoke model, which yields both economies of scale and provides network and operation cost optimization benefits. Second, high number of tests, revenue, and adjusted EBITDA per footfall driven by its integrated model and high individual consumer business mix. And third, a network whose size enhances its purchasing power with suppliers. Now, moving on to the suppliers. The key suppliers include a diverse range of leading multinational equipment, instrument, film, reagent manufacturers, including some vendors who sell more than one range of products. Vijay has a comprehensive range of approximately 740 routine and 870 specialized pathology tests and approximately 220 basic and 320 advanced radiology tests that cover a range of specialties and disciplines. Now, moving on to the ESG aspect of the company.
When analyzing a company, it is also imperative to check its sustainability, which is why we also did a ESG analysis. Firstly, from the environmental aspect, the company is focusing on energy consumption and technology absorption. And not only this, it ensures a proper ecological balance through afforestation programs and mostly focusing on conservation of marine life through various supportive initiatives like welfare services to fishermen in Andhra Pradesh. Next is social aspect. Initially, the company used to focus more on poverty and promoting education to underprivileged. But now, in the last 2 years before the launch of IPO, the company have expanded their social program towards women empowerment, rural development, and also supporting to many army veterans and war widows. In terms of CSR breakup, majority of the amount is devoted to education apart from the PM Relief Fund. And out of a total of 17 UN SDGs, the company broadly covers 4 out of it based on its CSR activities. Lastly, moving on to the governance scenario. So the management and board both have good experience in the diagnostic and healthcare industry, and 3 out of 8 board members holds a doctor's degree. 25% of the board members are female and 50% of them are independent directors, but still they are involved in some various decisions of the company. Even though there are 2 drawbacks, which are high promoter stake of 55% and legal proceeding being run on Ms. Suprita Reddy, the CEO, the strong governance support backed by strong leadership and management team has made the company achieve various accolades in last 4 years itself. Moving on to financials of the last 4 years, we see that the company has been able to maintain an increasing trend in its EBITDA and PAT margin, while the gross margin is within the same range itself. And the major reason for this is the saving of employee benefit expenses, which has declined from 17% of the revenue down to 15% of the revenue in the last 2 years. This has also led to rising return ratios over the years. And speaking from a leverage perspective, capital gearing ratio has been on a declining trend, backed by stable interest coverage ratio. On the liquidity front, the rise in current, liquid, and cash ratio in FY21 was on account of higher sale of investments. Otherwise, the ratio on the liquidities front as well from FY18 to FY20 has been on a similar scale. On the operational front, the tests performed did see a marginal decline in FY21 on account of lockdown of first quarter, but there was good growth seen in Q1 of FY22, which is just before the launch of IPO, and the company has been able to achieve 30% of the total tests that were performed in FY21. Speaking from the last 2-year trend and on Q1 numbers, the company expects to post a healthy financials in FY22. With this, we move on to valuation.
Coming on to valuation, we are projected opening of 59 new test centers over the course of next 5 years, out of which 16 will be in Eastern India. The capex will cost Vijay Diagnostics rupees 115 crores on average over the next 5 years, which will be funded by internal accruals. For calculating cost of capital, we have used the beta of peer companies. In order to value the company, we allocated majority weightage to DCF with 20% allocation to relative valuation. On sensitizing the WACC and terminal growth rates in DCF, we found that 20% upside is there for the company. On sensitizing the WACC and terminal growth in DCF model, we obtained a possible price range of 511 rupees to 669 rupees. For relative valuation, we used P by E and EV by EBITDA multiples, where Vijay Diagnostics was trading at discount compared to its peers. The forward trading multiples of competitors discussed earlier have been considered firm definitive. Our team also performed blue sky and grey sky scenario analysis, where we showed a potential upside of 29%, which can be associated to higher than anticipated customer footfall, average revenue per customer, and better operational efficiency. Grey sky scenario shows a downside of only 9%, which can be associated with insufficient operation of new test centers and opened and some risks, which is explained further in the last slide. Moving on to Rationale. Based on the financials and valuation, we expect a strong 37% upside in the company with a target price of 728 from a 2 years target perspective after the IPO launch. Moreover, we expect that as per listing, we can achieve 10% listing gain. For fundamentals, we still give a buy rating for a long term. The key drivers that will drive the trend in share price are increasing health awareness, especially post-COVID, changing health profiles and demographics, rising income levels in southern India, and most importantly, conducive government policies which are favoring the company. Now, these were the external drivers, but from deeper level, the internal factors that will drive the company in future are increasing presence of core markets in which more centers will be opened, and also trying to eliminate the smallest service providers. The company aims to hold a monopoly in Telangana while at the same time provide best customer experience to the clients. The company ensures to provide speedy services and operates on a hub and spoke model with established hubs all around Telangana and Andhra Pradesh. The company aims to increase its total spokes from 45 to 60 in next 2 years and providing door-to-door services, which will be one of the competitive modes the company will hold. Being highly customer centric, it provides a variety of services like health screening, wellness packages, lifestyle management, and is not restricted to just radiology and pathology services. This enables the company to maintain its high B2C share of 93% that is unparalleled by anyone in the industry. With highly concentrated operations, the company plans to move to Eastern India and are replicating the same hub and spoke model over there. Acquisition of Medinova in 2014, the management plans to make that center as hub and now plans to open up more spokes with target of 4 to 6 in FY22. Lastly, holding the fundamental base, the company aims for inorganic growth to expand its presence across India and make sure that they are well positioned to take the advantage for those consolidated opportunities. In conclusion, the key mode of the company remains at robust hub and spoke model, strong R&D support with high brand recall and dedicated management team who hold strong industry experience and being in integrated services providing of both radiology and pathology. Moving on to risk.
So our rationale is subjected to some risks which are highlighted here. Firstly, the company has high operational concentration as close to 90% of the revenue comes from Telangana itself, which is why now the company is planning to expand its diagnostic chain to other parts of India, especially in terms of Eastern India. And even RHP highlights that they have made plans to open up 15 new centers in FY22, of which 4 were achieved till June 2021. Since diagnostic industry is highly competitive with the presence of small service providers, there's always a challenge that patients might shift to other players, which leads to fall in market share as well as profitability. And in order to cover up, Vijay Diagnostic is focusing highly on R&D as well as the speedy process through hub and spoke model. There's also a reliance on third party for sourcing of various equipments, and any termination of agreement might pose a challenge. Moreover, with high reliance on data, there's always a threat of security breach. And lastly, there are some legal risks involved also, as Enforcement Directorate ED has asked the company to furnish some documents, which is also hampering some of the management's time. But even with these risks, we strongly believe that the company holds a good fundamental, and Vijay Diagnostics should be a buy for the IPO scenario for a long-term perspective. And with this, we close our presentation and now open to questions. Thank you so much.
Thank you, team. I request our judges to kindly start with the Q&A.
Can you go to the risk slide one?
Sure, sir. Visible, sir?
Yeah. What are these legal risks that you talk about?
So we're talking about two legal risks. Firstly, is that Ms. Supriya Reddy, who's this currently CEO, she's involved in some legal proceeding as of now, and is being charged with some acquisitions. And secondly, the legal risk that you're talking about is that Enforcement Directorate has also asked the company to furnish some documents, which is more in terms of financials, tax returns of the last 5 years. So
To
these
add on to that, sir, there is also some claims from the customers regarding false results that have been they have been accused of being inefficient of giving the right reports that has allegedly impacted their health and their treatment. So that legal risk is also there, which evolves from the operational risk itself.
When you evaluated the peers, did you see that this legal risk is relevant only from a Vijay Diagnostic point of view, or is this something which is common risk across companies in this industry?
In this industry, sir.
Yes, industry. So basically,
Can you name such similar cases for Thyrocare?
So again, so in terms of customer care itself, I mean, the accuracy is the most problem. So whenever a test
about
is
the
being...
promoters, very specific question for
no,
when
no,
you
sir,
say
not the Supriya Reddy perspective. No, sir.
No, so my question is very straight, very pointed, okay, and try to give a crisp answer to this, because what I'm trying to understand is the company that you have chosen has a fundamental issue in terms of legal cases against a promoter, correct?
Right.
When I asked you a question whether this is a prevalent risk across companies, you said yes. So when you said yes, what are those examples when you say that the legal risks are common for other companies also in this industry?
Can I take this?
Yeah, sure.
So when we said yes that this the legal risk is prevalent in the industry, we meant the risk that is there from customer cases, that is the false reports and inaccuracy of the reports, but not from the perspective that the promoter or the management has been sued with regarding something that is out of the purview of the company's operation. So that legal risk is as an individual of that management employee, but that is hampering some brand value of the company.
How critical is this risk in all your evaluation purposes? you have done all sorts of sensitivity analysis. You've shown
Right.
blue sky, green sky, various types of skies. What happens if this goes for a toss?
So
Sir,
which is
if
why
this
we
goes
also
for a toss,
shown it. Yeah,
yeah, go ahead,
conservative
sorry.
scenario we have shown. Yeah. So, as you rightly mentioned that this might go for a toss and the operations could go south. That is very true in that sense. So, which is why we have also highlighted the conservative scenario as well in our valuation. You can see that, sir, that gray sky actually depicts the account of all the risks that we have taken. So, any downfall that we see in the operational aspect, that might lead to a downfall in the listing gain as well. So, as of now, on a moderate and a very basic scenario, we have shown that we'll get 10% listing gain. But
Have
if
you
anything,
are you saying you have quantified this legal risk in your valuation?
No,
so we
sir,
have shown
it's
conservative
partially.
from an operational front.
Sir, like you said, if it goes for a toss, for some time the operations and the revenue of the company might take not that high growth rate as we expected to. And in our conservative scenario, we have taken lesser growth rates, average footfall of the customers and test per customers that has been at a lower level as from the moderate scenario. So that's how we have partially covered that, but obviously we cannot
Have you heard
quantify
about
exactly.
DHFL? Have you heard about DHFL?
Yes, sir.
Have you heard about ILNFS?
Yes, sir.
Are these risks similar to that when you were doing your valuation analysis?
It might be, sir. It might be, but right now we don't have enough information to compare that directly to DHFL or ILFS, I would say, because that business was it is a different model with a lot of capital involved in that, and lot of projects on a very larger scale, and lot of group companies and all of stuff, that there is a lot of scope of something like that happening. But over here it's not something that complicated, and it's pretty much simple. So
basically it's
that is
two
why.
different industry, and over there high amount of capital with lot of, even in terms of Vijaya Diagnostics, sir, even if one promoter is not is involved in some legal proceeding, there are other promoters as well who can take charge actually very easily, because
How many
the
promoters
background
are
and
there? How many promoters are there?
so there are a total of 5 promoters who have the seating in 8 out of a total of 8 board members.
Okay, thanks. Yeah, Hemant sir.
So, Ambuj, carrying forward your logic, the board of directors has 2 women directors, right?
Right, sir. Right.
For that matter, I think 6 or 7 total directors.
Total 8 directors are there, out of which
total 8 directors.
Yeah, 8 directors.
If suppose one of them goes behind bars,
okay,
will you still retain them as a director, saying that it's okay if something further happens, there are 7 other directors?
No, sir, obviously, we won't say that. Obviously, no doubt in that. If anything goes back behind the bars, it would cause a very big challenge.
Or if there is a case, serious case against that. So you will say that 7 other directors are there, they will manage it?
No, but my point was on the front that, that they have good management team who will be able to handle those part of the operations when some legal proceeding is going on.
So
that's from that perspective, sir.
So if HUL, which has got a very good management team, and it is bought by the DHFL promoter,
right,
you will be completely fine.
No, sir.
Obviously, no, sir, not fine, sir, obviously.
Sir, to put it very simply, I would just rather say that we totally agree that risk is there, and however, to compare this current scenario, current result to that of DHFL or ILFS would not be pretty much correct, because we always there's a possibility, and even if there's a possibility, like we said, if there's something goes for a toss, the blind recall might certain impact, it might be impacted by customers' orders. So that has been quantified in our the lower growth rates and lower revenue in the future years in the conservative scenario.
When you are looking at an investment, does this count as a risk based on which you will simply say no to invest? Or is it an acceptable risk? It's okay. One of the promoters is facing cases and going on.
The quantum of the risk right now, as it stands right now, it might be it's like not a no, it's not a no, I would say, at the current stature, at the state at which the affairs are right now. But so definitely,
you are saying falsifying the reports is you are considering it as not a significant risk.
So you can see that legal regulations also we have shown in impact of it, we have shown on insignificant and probability of occurrence also, and on a medium scale, because we see that it's not much higher.
I agree, everything is fine as long as we
Right.
consider it as an insignificant risk. So my question was whether falsifying reports, can you consider it as an insignificant risk?
No, sir. That falsifying reports is also
Falsifying
very
reports,
big
sir, it's
challenge.
still in the process, sir. It's like
So the case is still, I think, in the process, and as my team member said that even in that scenario, even in the worst case scenario, we have taken the the lower growth rates and the lower footfalls, and we've incorporated it in the revenue and the.
And we believe in the model, the hub and spoke model, that expertise in the service that we have.
Operational issues with a legal thing. Legal issues is a yes or no. Okay.
So we are saying that definitely legal risks are there, no doubt in that, sir. But as of now, the quantum of it is very low. That is what we're trying to say.
Okay. I think we have exceeded time, but still I will take the liberty. One more question.
Sure, sir. Yeah.
Have you checked since you have used the peer group comparison, have you checked the past 3 years or 5 years return of these companies?
So
what is the stock price return of Metropolis or Dr. Lal's, Dr. Path Labs?
So in terms of, we have checked the EBITDA margins. I'm not sure of the PAT margins, sir. So EBITDA margin for
not margins.
Okay.
What is the stock price return? Have they returned about 8%? Cost of equity when it is 8%.
Right.
That is what would have been the expected return. So past 5 years, they have returned 8% per annum only or something more? You have not checked?
No, sir. They have returned a high return definitely. But since when we calculate the cost of equity, since there is right now the market is currently structured with 11% market premium, and all the companies are debt free, so the beta is pretty much at a lower side. That's how we have calculated cost of equity. And this cost of equity we have calculated as from the future 1 year and 2 year perspective. However, it cannot be matched from the past that what has happened. So it might not be replicated as what has happened in the past.
You are using beta based on the past, but saying return should not be taken from the past. Okay.
Sir,
matter for
what I meant is I meant is that when we calculate the cost of equity is always from perspective what is the future expected return from the market or the borrowing cost that a company might have. That is why I was saying that.
But beta is based on past data.
Yes, sir. Definitely, sir.
Okay.
I have just one last question. You have taken P multiple and EV by EBITDA multiple, correct? If I were to ask you that between the two, which is the correct multiple for a company like Vijay Diagnostic, what would it be and why?
So probably I think both of them are equally good.
No, you have to choose one. You are sitting in front of the promoter. You have to give him value of the company, and you have to choose one method to convince him that P by E is right way to value his company or EV by EBITDA. Which one would you choose and why?
Can I take that, Ambuj?
Yeah, sure.
Sir, it would depend on the peers that we are taking. So to be on the safe side, some companies don't have the manufacturing facility or the testing facility on their own, and they have outsourced that. So to bring it to 1-to-1, we would use the EV by EBITDA just in case they are outsourcing the testing, resourcing the testing services, so that we can compare on the pre-depreciation figures that is there.
What is EV by EBITDA of comparable companies?
So
just a second, sir.
Yeah, so for Thyrocare it's somewhat around 19x, and for the rest of Metropolis or DLP it's somewhat around 32x, sir.
Okay.
We're talking about the forward multiples, sir.
Okay, thank you. I have no further questions.
Thank you, team. With this, we come to an end for our presentation now. I request you all to kindly lower your hands.
Thank you, judges.
Thank you, judges.
I would request everyone to give a huge round of applause to all of the presenting teams. These were some amazing presentations, and I'm sure that our judges would have an extremely tough time deciding the winner.
Good.
Now I would like to request our judges to move to the breakout room to decide who would be the winner of Ojas XIV FINVISOR.
Sure. So Will we move on?
So we'll be
ourselves?
moving you to the breakout room.
Okay, you will move. Okay.
Yes, sir. And you will be accompanied by Ronak in case you have some doubts.
I just like to wish all the best to everyone for this competition and your time in your respective B schools. Have a great time.
Thank you, sir.
Thank you, sir.
Yeah, all the best. We will come back in soon.
Yes, sir. Thank you, guys. So as a token of our appreciation for all of the efforts that each one of you has put into these amazing submissions, first of all, we've put a message on chat as we would like to mention you all on our official account. I request you all to kindly fill the same. Additionally, we also have something else in store for you. Now, I would request you all to kindly fill up the link that we've been sending here and vote for us for the competition and for Ojas 14. Please tell me if you're able to access the chat and the link. I request all of you to kindly open the link and vote. Thank you. I would request you all to kindly open the link and vote for the event and the festival. Please let us know if you're having or if you're facing any issues while voting. Additionally, we're very welcome to feedback for the event, and we would love if you could all contribute towards the same. Guys, we would love some feedback on the event, anything that we could have done. And till then, we're going to be waiting for the judges to declare the results. We'll be declaring the results here in the meet itself, so I request you all to kindly stay connected. Hi, Nisarg.
Hey, I just wanted to give one feedback, or it's like more of an appreciation that you guys considered that Omicron was here, and you considered the COVID wave and pushed back the deadline for submission by 10 or so days. And that was really a great decision as an organizing team. So cheers for that.
Thank you. We do realize that it has been tough on most of the B schools and not even B schools in the whole country. And we did take into consideration that this would be something that would be difficult. So thank you.
If anyone has any suggestions on how we could have improved even in earlier rounds, we're very much open to any feedback for improvement.
Guys, as soon as the results will be announced, are ready, I'll be giving out an announcement. And I request you all to kindly switch on your cameras when the results are going to be announced. Hello all. The judges are back with the results. I request you all to kindly switch on your cameras.
So,
Sir, so on behalf of Ojas, sir, I would like to thank both of our judges for taking out their precious time on a Saturday morning, that too, for the event. A big shout out to all of the teams for showcasing their talent and being part of our journey. And now it's time to announce the results. So 5 teams presented before the panel, and you will certainly agree with me that all the teams were excellent and came up with a great, detailed and well-structured presentation. Now I would pass it on to the judges to kindly announce the runner-up and the winner for the event.
okay, so first of all, thank you all for joining into this competition. I hate to use the word competition. It is not a competition. Joining into this assembly, you can say. So first of all, that each of the teams has done very good work. I mean, kudos to you for collecting data, making such presentations, detailed ones, and talking about them. So very good, each of you, right? And broadly, as I said in the beginning, if you recall, it's partly your doing and partly luck. Today, God knows from where we asked which question and you answered or not answered. So that becomes a factor. And second is some general broad line of thinking and line of approach. That is what we considered, while ranking you. So it's just a rank, each of you, as I said, deserve an applause, right? So to begin with, congratulations to all of you, right? Now, so as far as finally, as far as the ranking is concerned, we have to announce the winner and the runner-up, right?
Yes, sir.
So the runner-up is the IIFT team, right?
Congratulations, guys.
Congratulations to you.
So the runner-up of FinVisor is not too far from IIFT. Big round of applause, guys.
Good. Excellent. Okay. So
just a quick clarification. Was it IIFT or which team? Because
is it
It's
not
too far. It's from
Frontliners.
Yeah, Frontliners were.
Frontliners from
Frontliners. You are IIFT only, no? So actually, sorry, I should have named the team name actually.
Frontliners, sir.
Frontliners. Right? Frontliners is the runner-up. And I'd request my colleague judge, Pujan, to announce the winner.
Sure, sir. So, firstly, as Hemant sir mentioned, I think all of you, the presentations are pretty well made. There was a lot of research since all of these are listed companies. The industries are fairly large. So I think all the 5 teams who presented, the depth that you guys had covered was pretty good. And all the best to all of you who are hoping to build careers in finance. Hopefully it works that way for you at appropriate stages of your careers. Now coming to the winning team is the Policy Bazaar team, which is Bank on It from NMIMS.
Thank you so much.
Congratulations to
the
winners and the runners up, and have a great time.
Really honored, so.
Thank you. Congratulations, guys.
Sure.
So I hope you all enjoy.
You will be Yogesh and your team. You will be a very well-known investor if you invested 9% equity. That's just one comment on the side note which I would like to make to all 3 of you. Nobody invested 9% equity, but I mean it's the output was not absolutely relevant. correct. The thought process behind it, the way you presented it, and this is not only for you but for everybody. The output is just a function of all the other aspects which have gone into it. So yeah, that's all I would like to leave a note with you guys.
Thank you so much for great feedback, sir.
Feedback. So.
Heartiest congratulations to all of the winners, and I really would like to thank the judges for being on board with us today for the event. Really a special thanks to you, and a big congratulations to the winners and the runners-up. Now I would request all of the winners, the runners-up, and the judges to kindly stay back. For the rest of you, thank you all for being part of Ojas 14's FinVisor, and I would wish you all to have a very wonderful day ahead.
Sorry,